Introduction. 5 key market factors.
Hello, 5 things we've been watching at Harvest over the past month. 1, all else equal, look at markets under the surface. 2, valuations, growth and volatility. 3, shock and awe or awfully shocked, the 50 basis point cut. 4, what's flowing, most inbound questions we've seen at Harvest. And 5, oh Canada or uh-oh, a look at data-driven conversations and a contrarian view.
Market overview and breadth.
Doesn't feel like it, but it has been the best first 3-quarter start since 1996 for the S&P 500. Month started with some volatility to the downside, but just like August, market remained in buy the dips and cash on the sidelines was deployed, pushing the S&P 500 over 2% for the month, the best performing September in the past 10 years. Importantly, we continue to see more areas of the market participating to the upside, with areas like discretionary, utilities, industrials, and REITs all posting positive gains. When more stocks and areas of the market are participating in the upside, that's a healthy environment compared to just a few stocks driving the market. One way to measure this is to look at the S&P equal weight, where all stocks are the same weighting compared to the index that puts more weighting on the larger names. One can see over the shorter term, the rotations we've talked about and the expanding breadth does favor equal weight. And barring an exogenous shock, this is a healthy for the broader markets and is supported by valuations.
Valuations, growth, and volatility.
Firstly, valuation multiples we know are slightly higher for the broader market, and that is skewed by the big 7, and that's been really driven by the earnings growth that they've seen. For the rest of the 493 stocks, though, we've already gone through several quarters of negative earnings growth, and the positive is that the earnings growth is starting to reaccelerate. Looking at valuations, we can see that the equal weight market is trading at a meaningful discount compared to the cap-weighted broader market. So there's 3 key takeaways. 1, valuations are reasonable and at a meaningful discount on the equal weight, while growth expectations are gaining more breadth, and this is a sign of a healthy market. 2, earnings season is around the corner, and it will be a very key earnings season. And 3, the macro environment is cooperating, but can change very quickly, and we are at the pivot point for both the Fed and the type of landing that we're expecting.
Navigating unexpected market moves.
So why did the Fed cut rates so aggressively? Well, economic data has been slowing and the overheated inflation continues to trend lower. Employment data sets were weaker than expected in early August, prompting the Fed to cut more aggressively. Jobs data, though, through early October remained supportive of the soft landing, and the market is expecting fewer cuts for the rest of this year and meaningfully less in 2025 and 2026. So why did bond prices move lower when the Fed actually cut rates? Bond prices are driven by the rates of similar duration. Although the Fed had not cut rates, bond yields have been falling quickly at the longer end of the curve. Looking at the yield curve, one can see that across most maturities, yields have come down significantly. So what could change? China stimulus driving commodity prices, or supply disruption in oil potentially causing a spike in inflation and the necessity to increase rates. Alternatively, the Fed could be late and jobs data could deteriorate more quickly, fueling a recession. For now, though, a soft landing and bullish sentiment remains in control, although volatility will be elevated around macro data, and of course, when investors are all on the same side, that can also exacerbate the moves. A measure of sentiment is the bull-bear ratio, and one can see that sentiment is heavily skewed to the bullish side. As options are priced off volatility, we expect premiums to be high in both equities and in our fixed income ETFs in this environment.
Winning on defense.
A quick update on where we continue to see the most inbound inquiries and recent flows. In equities, we see playing offense with more defense as rotations continue under the surface. HHL and healthcare continues to be focused given some of its defensive characteristics and consistent high monthly cash flow. It's coming up to its 10th year anniversary this December. HUTL and utilities, and similarly in REITs and HGR, we continue to see the focus on their global attributes. Both areas tend to benefit from declines in rates in a lagged way and also tend to have unique long-term growth dynamics driven by AI power demand and data warehouses. You can check out some of our insights on our insights page and some of our more recent reports. We've also seen strong interest in our fully diversified equity income strategies in HDIF. In fixed income, HPYT, or Happy T, continues to see the most amount of inflows following the backup in rates through the end of the month and elevated volatility driving premiums. However, more inbounds have started looking at the belly of the curve in the 7 to 10 year range. We are seeing a meaningful uptake in interest and flows in HPYM. Lastly, while not often coming up in conversations, discussions about Canada are increasing.
Canada's economy, status, drivers, and opportunities.
In our fund focus, we're going to take a look at Canada. On an economic basis, Canada finds itself in a predicament. Politics aside, the bear will point to the GDP per capita, and it's just been awful. Coupled with employment statistics that are showing rising unemployment and jobs data that is heavily skewed by government hiring and a denominator in some of those per capita equations. So battling a weak economic environment and a housing supply shortage keeping prices elevated, the Bank of Canada is in a tough spot, needing to cut rates, but in doing so is at risk of refueling housing prices. Every month, though, I'm reminded as I pay my bills, Canada is home to some great companies, and importantly, many of these companies operate as oligopolies and are price setters, meaning they can generate strong cash flow. This at a time when the market that is forward-looking has discounted nearly the widest valuation gap between Canada and the US in some 20 years. We continue to see growth opportunities in the areas in the US that are not available. We highlighted healthcare, tech, and some of the yield-sensitive areas that we don't have exposure in the domestic market. As the Canada contrarian discussions are increasing, HLIF has 30 stocks. When you look at the names, many fit the bill of oligopolies, generating strong cash flow.
Subscribe to Harvest ETF's Insights. Join us and stay informed.